Hello, and thank you for joining us today for our Lunch with Lou webinar. My name is Jimmy Bassett, and I am a Senior Advisor at Altfest. Today, we'll be joined by Lou and Andrew Altfest. Lou will be discussing his outlook for the markets and the economy, and later on, Andrew will discuss how we are positioning your portfolios today and for the year ahead, 2022. After the main points are covered, I will ask both Lou and Andrew a few select questions that our clients have submitted. We expect today's call to last about 45 minutes, and a recorded playback of this webinar will be available should you wish to listen to it again or forward it along to someone who would be interested. But for now, it is my pleasure to introduce Lou Altfest.
Welcome. I brought along Andrew Altfest, who not only is more handsome than me, but has some significant points of view on investments that you should be aware of. I will give you my perspective on the outlook. The first of my promised predictions that this year will be one of true change. All of us are tired of the same old, and we should be able to experience new developments. It seems to me that from a COVID perspective, we are likely to make material strides. There is great potential for a lessening of impact because many believe future variants will be less impactful. And because of benefits of current and future pharmaceutical products to treat those who are affected by future Omicrons. You may still carry a mask, but use it measurably less often. Economically, COVID is likely to have less influence as the year progresses, and even less impact in future years. But right now, COVID may put a dent on consumer spending euphoria. The GDP growth figures say 7% for the year 2021 will be replaced by those more like normal growth. The shortages of selected consumer and business goods will be reduced steadily, and their drag on the economy largely over by the end of the year. What remains is inflation. As I have mentioned before, inflation is not so affected by rises in commodity prices, with the exception of energy and also for shortages that are around right now. Instead, it is most affected by labor costs. We are very close to full employment. Just like manufacturing and factories can only produce so much in good businesses, particularly those in services, we need to be able to hire, or they need to be able to hire new workers to grow. The administration has a conflict of interest. It wants to continue to put more dollars in the hands of the working class, but it doesn't want the country to suffer through a blast-off in inflation. The Federal Reserve most likely believes that it has given a lot of impetus to the economy by bringing interest rates down. It is now concerned about inflation. It is likely to begin a series of rate increases that will take years to complete. Interest rates are likely to go up perhaps quarterly until a normal rate is established. It is concerned about striking the right balance in the pace of rate increases. Too little will not influence inflation enough, and too much too quickly has the potential to cause a recession. My assumption is they will be successful in restraining inflation, in part by slowing economic growth. Recently, interest rates have moved up by about 30 basis points. I know, but many of you don't know what that is. It's like 0.3%. But that is, this has taken place not through Fed's tangible actions yet, but through the markets anticipating future rate increases by the Federal Reserve. That seemingly small amount is noteworthy. Rates don't usually move up by that amount that quickly. So there's great anticipation for the Federal Reserve to move up. One last point about labor costs. You can think of labor versus management, but which is represented by the owners of the representing the owners of the country, of the company, I should say, as in competition for the cash flows of the businesses. Post-World War II period saw labor through the use of unions and strike threats as having the upper hand. Then unions, which perhaps were most effective when manufacturing dominated the economy and began to have a reduction in power as services and other factors reduced the percentage of jobs held by American workers. The unions want to restore their bargaining power. In addition, workers aware of the movement toward full employment that we're at now are seeking higher wages and are likely to get them, which will be highly inflationary. It will take a strong hand in Washington to bring wage rates back into place. I look for a moderation of inflation from 7 to 8% now, but they'll still be higher than the 2% desired level that will come out. On the plus side, more favorable year-to-year energy prices. We're at a peak at the moment, and declines in use of used car prices should help. Overall, the market has gone through a remarkable period since our 2008 recession. That recession hit the entire country, but particularly the working class. It was even worse for countries abroad who had the same recession. It could be said that the problems abroad led to the shift to authoritarian governments worldwide, as their economy and stock markets did not bounce back and reach new heights as ours did. We led the world over this more than 10-year period. One big benefit our country had was the rapid rise in large technology companies' growth rates. No other country has technology to any extent relative to us, with the exception of China, which is growing. Today, our valuations are high, with PEs at 21 versus a normal 16. One big reason for such valuations is very low interest rates. With interest rates currently less than 1%, the competition for stocks by bonds is very weak, allowing stock prices to climb beyond normal levels. Rapid inflation today will likely force the Federal Reserve to raise rates steadily to attempt to put out the inflationary fire. Some slowing in the economy because of higher rates is, as discussed, likely to occur, and the bond rates rise from the dead. I consider it dead at today's rates. They are insignificant. They will gradually present more competition for investors' dollars. Meanwhile, high inflation means that there will be more pressure for business to provide a justification for current levels of stock prices and future growth in them by continuing to have sizable increases in profits. Many companies will be raising prices to have that occur. The current level for many large technology shares relative to the rest of the market is out of whack. Unless there is a recession which will cause investors to emphasize high assured growth companies, technology is likely to underperform normal companies whose profit outlooks are all the ones that are favorable, that is. High interest rates make valuation levels for steady growth companies less attractive. To sum it up simply, value stocks should outperform technological growth companies. While we hold some growth companies, we have an emphasis on value in our portfolio. So having said all this, let me give you, as I promised, my 5 or so items, many of which are deviations from consensus. We'll return to the deviation from consensus in a question later on that came from you. Interest rates will rise more quickly than expected. They may rise by more than 1% a year in total. Inflation, number 2, will moderate from the current 7% level by the end of the year, but still be higher than normal. 3, corporate profits will rise by more than anticipated, even though the economy will slow down. As mentioned, the economy will slow down doesn't mean that going into recession. As mentioned, value stocks will outperform growth stocks. Finally, job shortages will be reduced by higher wages and lower COVID problems, and will draw workers back into the labor force. We're close to full employment, but the number of people working is down sharply. Some of those people who are working, given the incentive with higher wages, will be moving back into the labor force.
Thank you, Lou. And now I'm going to bring on Andrew to discuss putting our best thinking into your portfolios and how we're positioning them for what's on the horizon.
Yeah, so thank you, Lou, for that great insight. And I think a lot of the broad strokes that you just heard about, I'm going to tell you how specifically they translate into how we're managing your portfolio today. I'm first going to talk about the changes that we made to your portfolio last year in 2021, and then I'm going to go into the positioning of the portfolio today. And if we look back, we go back in time to 2021, the markets were not pricing in higher inflation, and interest rates were going to be were not perceived as going to increase in the near future. And we weren't thinking that way. We were thinking that inflation was there was definitely a risk that inflation was not going to be transient, and that conviction grew during last year. And when we're in a period of higher inflation and higher interest rates, what tends to do poorly and tends to need attention is the bond side of the portfolio. And so many of the changes that we made in your portfolio last year were on the bond side. And today we're managing a very non-traditional bond portfolio for you. Bonds actually as a whole were down 1.5% last year. The bond market was down 1.5%. But the bonds that we manage and your bond portfolio did much better, and it was because of these changes that we made last year. Stocks in a higher inflationary environment have historically kept up with inflation, and there are certain stocks that do better than others, and those we're paying particular attention to and have allocation to. But on the bond side, that's really where we've had to spend time. So let's talk about what we did last year in your portfolio. First, on the bond side of things, when interest rates are at risk of increasing and due to higher inflation, you want to own shorter term bonds. So we've taken the bonds that we've owned and we've reduced the maturity of those bonds. Those bonds are less susceptible to increases in interest rates. Interest rates will cause those bonds to decline less in value. Get your money back sooner, and you can reinvest that money into higher yielding bonds that are that have the prevailing interest rate in the market. So in January, we took our an ETF that we own, which gave us exposure to intermediate term treasury bonds, and we traded that ETF for bonds that are tied to mortgages in the housing market through you could say, being reunited with an old friend of ours called Angel Oak. Angel Oak, for many of our longtime clients, you'll probably remember that we have been buying non-agency mortgage-backed bonds since the financial crisis. There was a great opportunity for them. And but a few years ago, we felt that they had reached their fair value, and so we removed them from portfolios. Last year, and actually in 2020, during the sell-off, we reinitiated a position through Deer Park. Deer Park Total Return, which invests in bonds tied to the housing market. And then in January, we added Angel Oak. Both of those funds did very well. Deer Park did very well in 2020. Angel Oak did very well in 2021. And that exposure on the bond side gives us less interest rate risk, exposure to and part of the bond market that offers the opportunity for more attractive returns. And of course, they're great. We like the trends that are in the housing market today, and housing has been a good place to be in inflationary periods as well. So we added Angel Oak. In March, we increased the allocation in portfolios to the alternative alpha strategy. The alternative alpha strategy is a strategy that we manage internally through ETFs that we initiated in 2020. It allows us to be very opportunistic, to make tactical changes. And not only has the strategy performed well since 2020, but what I really like about it is that it's performed well with less correlation to other traditional investments. And so it's a great diversifier. It's also managed risk very effectively. And so the returns have been strong with less risk and less correlation, which are all things that we like to see when managing portfolios. So we added that exposure by selling several investments. We sold one of our buffer investments tied to the international markets. We reduced at that time our India exposure, and then we also reduced our Loomis sales bond exposure. Corporate bonds have become much richer. They offer you minimal additional yield compared to plain vanilla government bonds. So we wanted to reduce our corporate bond exposure. And then in April, we further reduced our India exposure. When we bought into the India fund in 2020, and it was just a much different investment at that time. It's moved up sharply. We had great profits on the India fund when we sold it, and we are optimistic about India longer term due to the great secular trends that are there, the emerging middle class. But the growth had already been priced into the shares, and of course, India has some other near-term challenges, like its population is the least vaccinated in the world. Then we also reduced the emerging market bond exposure that we have in portfolios. That was timely because emerging market bonds did perform poorly last year. There was a part of the bond market that declined, so we reduced that in April. And we had some concerns about China and how China was addressing the housing market there that is extremely high. We also added data center REITs We added both data center REITs and digital infrastructure REITs that gives us exposure to the digital economy. And further, we increased our other non-agency mortgage-backed bond fund, Deer Park Total Return, which gives you a little bit more zip than Angel Oak. It's a little bit more aggressively positioned in the non-agency mortgage-backed bonds that it owns. And then finally, in April, we increased our position to Jennison Health Sciences Fund that's managed by a very strong biotech team. And it's a fund that we followed for many years, and we like our exposure to the healthcare market. And we think the healthcare market is priced reasonably compared to other parts of the market with good growth prospects as well. In September, we further reduced our emerging market bond exposure, and we purchased short-term treasury bonds. So you see we went to more of a plain vanilla stance, and shorter term, again, less interest rate risk. And then in November, we took our real return bonds. So we have inflation protected bonds that actually do well when inflation picks up. So they give you more money. As inflation picks up, you get a higher return, get more money back from the bonds. And so that was the best part of the bond market to be in. We had a position in PIMCO Real Return, which did very well. We reduced that position later in the year. We reduced it in November. We didn't completely eliminate our inflation protected position. We took the proceeds and we bought more treasury bonds, but we also bought shorter term inflation protected bonds, again, because we wanted less interest rate exposure, which has really helped as interest rates have moved up in the first few weeks of January. So it's a very non-traditional bond exposure, and I'll also mention that we've reduced the bond allocation in general using and added alternatives to the portfolio. And those alternatives have also helped us, particularly in a year last year when bonds were down. Now, how are we positioning portfolios today? Well, we're not defensive. That's not how we would characterize ourselves, but we're conservative. And we're not expecting a recession due to interest rates moving up. We think the economy will continue to grow, but we want to be offensive where there are opportunities and defensive where prices are very high and where we think there's price risk. And so there are parts of the market today that are more attractive. You can get for reasonable prices, you can get good businesses. For example, in the pharmaceutical sector, telecom, there's some biotech stocks, and we like cyclical stocks in general. We again think that the economy is going to be continuing to grow, so cyclical stocks are economically sensitive. We like more economically sensitive stocks. The prices are more reasonable. And where we're defensive and underweight, as Lou mentioned, is in technology. In technology, we're underweight. The share prices there are very high. Large growth in general, that part of the market is 50% higher than it has been historically. And so we're, particularly in the US, we're favoring more, we have a value orientation, meaning that that style of investing is the one that we're deploying in your portfolios, and value is priced significantly better than it has been historically to growth. Now, where are we getting the cyclical investments, do you ask? So we're getting them through the mutual funds that are in your portfolio: Oakmark International, Morris, Brandis, MFS, LSV. Through some of the infrastructure investments tied to energy, and also through the internal portfolios that we're managing, through the Altfest active large cap stock portfolio, through the alternative alpha portfolio. We're getting cyclical exposure due to positioning. In addition to the cyclical exposure, we have a meaningful position in Asian growth investments. So Asian technology and consumer investments, those investments are out of favor, and you can get fast-growing businesses in Asia at value prices today. And so Asia has always blown hot and cold with US investors. Flows are volatile, and taking contrarian positions in Asia at the right time, historically for us at Altfest, has been a winner. And so we see that same opportunity today. And we've built, we have a meaningful position in Asian growth, and that's actually helped the first few weeks of this year as there's been a rally in those shares. So the investments that we have in your portfolio that give us that exposure: T. Rowe Price New Asia, Morgan Stanley Opportunities Fund, and as well as we have some exposure in Brandis and Matthews that has some of that exposure, as well as Matthews Innovators gives us that exposure. Beyond those mutual funds, we have in our internally managed portfolios, both in the stock portfolio and the alternative alpha portfolio, we also have exposure. So altogether, between the funds and the individual strategies, internally managed strategies that we have about 9% of the portfolio with that Asian exposure today. So we're constructive on that part of the market, as you can see. So let me now turn it over to back to Jimmy, and would love to hear your questions and answer your questions and hear what's on your mind.
Thank you, Andrew. So yeah, we'll go to the questions now. Some that have come through before. I think at least one that's come through while we've been on. The first one, I think, Lou, might be good for you. The first question we have is, what are your feelings about China? Aren't their the recent business moves anti-capitalistic?
All right, before I tackle that, I just want to mention that a lot of what Andrew mentioned comes from what we did, both of us, when Andrew said we should buy some, get interested in some specialty mutual funds that specialize in one particular area. And we went around the country and talked to them, like biotechnology in many other areas that have paid out for us over time. Let me then now turn to your question on China. Many of China's problems, I believe, are short term. They are too tied to the world, producing 1/3 of world exports, to dismantle their capitalist system. It's too profitable. They have a problem with their zero COVID operation, and it may force further shutdowns that would add to world shortages of supplies shorter term. They may change their COVID policy after their hosting of the World Olympics. Meanwhile, their GDP recently has been little higher than the United States. After phenomenal growth over many years, their growth coming up is projected to be 4%, which isn't very different from what it will be for projected for the US this new year. But it's interesting that consumer sales, which are hurt by the cutback in housing performance, were only flat in recent quarters. No growth in consumer sales. That's really something. But they will get over these problems and find ways to incentivize their households to produce something that they're very short of. Do you all know what they're very short of? They're very short of children. They're not producing them. At one time, they had incentivized people to not have them. They are likely to influence people to have more children, and they've already attempted to do so. We have, for the time being, concentrated in above average amounts in China technology stocks, which are selling at very reasonable valuations. Like one you may be familiar with is Alibaba, which is the Amazon of Russia, and in some ways even more diverse.
Thank you, Lou. Moving on, there's actually, we have a few questions here about bonds and interest rates, so I think I'm going to try and combine them a bit. The first one being, at what interest rates would people look to bonds as competition for stocks as investments and not just safety? And kind of along those lines as well, I had a client ask, will the Fed really be able to raise those interest rates that are required to fight inflation and without pushing national debt into an unsustainable level?
So let me answer the second part. The Fed is the king. There's an expression that goes on from an old finance professor that I had, kept repeating it, called "Don't fight the Fed." In other words, don't ever assume that the Fed won't be able to do what it wants to do. It's amazing that they were able to bring rates down. Market rates would be perhaps 4 or 5% right now. Instead, the 2-year U.S. government, 10-year U.S. government is less than 2% and it was less than 1. Amazing that they're able to do it, but they do it. That's in contra to what the market would do, and everybody knows the expression "don't fight," so that's why you see that happening. All right, now, what rate would bond be competition for stocks? You know that 1 or 2% rates for bonds is not going to get anybody out of bed. And of course, the projection on whether what rate they will get to be competitive with stocks has to do with inflation. No one wants to buy, say, hypothetically, a 3% yielding bond when inflation is 5, because you'll have a 2% loss in buying it. 3 minus 5. Assuming somewhat close to normal inflation rates, the figure would have 10-year U.S. government bonds of 3 to 4%. At that level, other investment grade bonds would yield 5%, and for conservative accounts, that would have them raise their bond allocation.
Thank you, Lou. And to kind of round up things with bonds, Andrew, this may go to what you had been talking about. What we did with bonds last year seemed to work out pretty well, but what are we looking to do with bonds at this point with, I guess, more and more pressure coming in like we've been talking about?
Yeah, so there are a few things that you can do in a higher interest rate environment where interest rates are moving up. The first is that you can reduce the maturity of the bonds, get your money back sooner, so you can invest in higher yielding bonds as interest rates move up. The second thing that you can do is you can own less traditional bonds, and I would say those non-agency mortgage bonds that we have in your portfolio, not only do they have shorter term, based on their nature of what they own, not only are they shorter term, but they also offer good appreciation potential. And then finally, you can own less in bonds, and that's what we've done. We've created this. We have an alternatives category which is quite unique, and we have within that category real estate. We have infrastructure investments. We have investments that are some of them are income oriented like bonds, but they themselves have more risk than bonds. They have less risk than stocks. Their underlying businesses are more stable. Their cash flows are more stable, and they can have they can move more independently of other investments in the portfolio. So while they themselves could have more risk than a traditional bond, their diversification benefit by adding it to a portfolio and looking at it on a portfolio basis with other investments, actually you don't have to take that much more risk necessarily by having them. So those investments, bonds were down 1.5% in 2021. Those investments did better, and that's a testament to owning something else other than bonds if you're less optimistic about those investments.
Thank you, Andrew. No, I think that's a really good outlook on kind of what we're seeing out there and where we're positioning. The next question we had that came through is, given recent market weakness, should I try and take my 2022 IRA distribution now?
As mentioned, the stock market is high now, and a correction could occur based on any material disappointing news. On the other hand, there is enough time for a correction should it occur, and then a bounce back. Remember the one, I'm sure all of you remember, the one about 2 years ago when the start of COVID resulted in a 30% drop and worries of more gloom and doom to occur. Then the bounce back resulted in a higher stock market overall for the year. Trimming the market is tough because you have to not only know when to get out, but also to know when to get back in. That's very difficult. We have some extra conservative assets currently, so I'm reluctant to take that step 11 months before year end.
Thank you, Lou. I think we have time for about 2 more questions. The next one here, I think, Lou, is definitely directed towards you. Is the guiding philosophy that Dr. Altfest adheres to, and who are the value-oriented people that have some influence on his thinking?
I am a contrarian thinker, but make sure that my opposite point of view only applies when it has some underpinnings logically. I don't just say, everybody's saying Y, so I'm going to say X. I have to have a reason for saying X. I wince every time someone says, why do you want to sell that stock? It has done so much better than the market. When you really have good time going on with a friend, I'm going to give you a parallel. You want more interaction with him or her. When you have a wildly performing stock, it is most often time to think about less interaction by selling it. But I understand that my advice is most difficult for people to follow. As a matter of fact, I expect to wince many, many times. For the majority of people, you could tell them that now until the moon comes up blue, and they will continue to say that. So I understand that. I pay attention to the people that I pay attention to, who are themselves contrary thinkers. Jeffrey Gundlach, John Authors, Jeremy Siegel, and Jeremy Grantham. And their original ideas are often helpful in my forming my opinions.
Thank you, Lou. And one last question here, which I think will probably be well suited for Andrew, is how has Arden Woods been doing, and what's on the horizon for the future there?
Yeah, so Arden Woods has been doing very well, and we've drafted a letter that will be going out to all investors in Arden Woods in the the coming days. So you'll get a more detailed update. But let me give you just some information about Arden Woods. We have made 21 investments so far. Those investments are projected gross pre-fee returns on the investments that we've made is over 40% annualized. We really like what we've bought. There are a lot of late nights, quick decisions, hard work to execute, and we really like what we've purchased in the fund. And so we're working very hard to continue to put the rest of the money to work. We've made purchases, then you're budgeting for rehab and improvements of those properties. And so we've invested already a meaningful amount of the fund, well beyond what we've called, given the purchases that, given the rehabs and improvements that need to be made. And then we're working hard to make additional purchases. And but anyway, we're very excited. We're already starting to think about the timing of a second fund, so more of our clients can participate, and you can make additional investments. And that could be that second fund can come as early as the third quarter of this year, depending on how fast we put to work the rest of the investments. But so far so good, and we'll be sharing more detail about the investments, some stories, some examples in the forthcoming letter to our investors.
Sounds great. Well, thank you both. I think that's about all the time we had for today. Thank you, Lou. Thank you, Andrew. And thanks everyone for joining and for sending us your questions. In case you joined today's webinar late, or if you would like to pass Lou's remarks along to a friend, we will be posting a replay of the webinar on our website, and we will be sending you an email once the replay is available. And of course, if you have more personal questions, please contact one of the members of your Altfest management team or call our office directly at 212-406-0850. Once again, thank you for joining Lunch with Lou. Have a nice day.
Take care.
Good show.